After Netflix's Q1 2026 earnings report, the market reacted sharply, with the stock dropping more than 8% in after-hours trading, surprising many investors. Hello everyone, welcome back. In this video, we will break down Netflix's latest earnings report and understand why the stock declined despite strong headline numbers. At first glance, the headline numbers look strong, with revenue growing 16% and operating margin expanding to 32.3%, both beating expectations. But markets don't just react to headline numbers, they analyze the quality of earnings and the forward outlook behind them. The 86% jump in earnings per share was not driven by core business growth, but by a one-time accounting gain. This gain came from the termination of a Warner Brothers deal, resulting in a $2.8 billion one-time payment to Netflix. Since this is a non-recurring item, investors are not considering it as part of Netflix's sustainable earnings power. The focus then shifted toward forward guidance, where Netflix signaled weaker growth expectations for the upcoming quarter. This indicates a shift in their future outlook. Slowing revenue growth and potential margin compression are now becoming clear risks for investors to consider. When future expectations are reduced, the market naturally adjusts valuations, which ultimately leads to stock price declines. When we zoom out from the quarterly numbers, the bigger concern becomes clear. Netflix's global growth momentum is starting to slow down. Regions like Europe, Latin America, and Asia Pacific are all showing a noticeable deceleration in subscription growth. This global trend suggests a challenging market for streaming services. Even in mature streaming markets, growth is no longer accelerating at the same pace as before. In the United States and Canada, revenue growth has also shown signs of quarter-over-quarter weakness. This slowdown in our core markets is a key concern for investors. This indicates that Netflix is transitioning from a high-growth company into a more mature growth phase. And this transition is where investor expectations start to change significantly. The global slowdown in Netflix market is forcing a reset. This expectations curve is adjusting downward, realigning with new realities. Because markets don't price current performance alone, they price future growth expectations. Let me illustrate with this comparison. Here, future projections command a higher valuation. That is why strong earnings were not enough to support the stock price. Netflix global subscriber growth is slowing, creating market headwinds. This shows the divergence, earnings up but stock price down. The forward guidance played a much bigger role in shaping investor sentiment than the reported earnings. This underscores the importance of strategic communication in volatile markets. And when expectations get reset lower, even fundamentally strong companies can experience sharp short-term declines. At this stage, valuation becomes just as important as earnings, because the market constantly reevaluates what it is willing to pay for future growth. Netflix was already trading above its historical average valuation multiples before the earnings release. Its current price-to-earning ratio is 52x, which is 15% higher than the historical average of 45x. This meant expectations were already high, leaving very little room for disappointment. The stock price hovered near this threshold, amplifying the pressure. When future growth expectations are reduced, valuation multiples tend to compress quickly. This chart shows how multiples like PE and EV/EBITDA decline as growth rates fall. This compression is one of the primary reasons behind the sharp post-earnings stock decline. The data shows a direct link to valuation contraction, causing the drop. Now, to understand long-term value, analysts often use discounted cash flow models. The DCF model projects future cash flows, then discounts them to find present value. This helps investors see a company's true worth. In Netflix's case, DCF analysis suggests the stock is trading close to its estimated fair value. This implies limited upside unless growth accelerates beyond current expectations. If Netflix continues growing at around 12% annually, returns may remain moderate rather than exceptional. This is why even a high-quality business does not always translate into high returns for new investors at current valuations. At this point, understanding investor psychology becomes just as important as analyzing financial numbers. The market moves in a cycle between fear and greed. Understanding this is key. When a stock is rising, investors tend to extrapolate growth far into the future without considering risk. But when expectations shift, the same optimism quickly turns into caution or even fear. This emotional cycle often drives short-term volatility more than actual fundamentals. While emotions spike prices rapidly, Fundamentals provide a stable base over time. In Netflix's case, the reaction was amplified because expectations were already elevated. The stock chart shows this perfectly. High expectations followed by a sharp, amplified drop. This highlights how sentiment can drive market volatility. Even minor changes in guidance can lead to significant price adjustments in such scenarios. This demonstrates the market's high sensitivity to forward-looking information. This is why understanding expectations is often more important than analyzing headline earnings. Visualizing this on the Netflix map shows expectations often reveal more than earnings alone. Netflix is facing a global market slowdown, as seen here. Markets continuously price in the future, not the past performance already reported. Exactly. The market is forward-looking. When future expectations decline, valuation compression becomes almost inevitable. This map shows the global market slowdown for Netflix. The resulting compression shifts key metrics downward, and that is exactly what we observed in Netflix's post-earnings market reaction. The global slowdown map confirms weakening growth across key regions. This led to the confirmed stock drop testing key support levels. To fully understand Netflix's reaction, we need to step back and look at the broader market cycle perspective. Every growth company eventually transitions through phases of acceleration, maturity, and normalization. Netflix appears to be entering a more mature stage of its business evolution. In this stage, revenue growth slows, but profitability and efficiency become more important drivers of value. As growth decelerates, metrics like operating margin and cash efficiency drive valuations higher. That is why investors are now focusing more on forward guidance than historical performance. Even strong past results cannot fully offset weaker future expectations. This map illustrates a global Netflix market slowdown, where past performance fades against future projections. Expectations dominate. This is a key reason why markets can react negatively even when earnings beat estimates. Netflix earnings beat, but their slowing subscriber growth caused a stock drop. This highlights how sentiment can override the numbers. The real driver is always the gap between expectations and revised outlook. When that gap closes or turns negative, valuation adjustments happen very quickly. This map illustrates the global Netflix market slowdown, where gaps are closing and valuations are dropping rapidly. This reaction is swift and significant, and that is exactly what we are seeing reflected in Netflix's post-earnings stock movement. The initial drop has now given way to a clear stabilization phase. This confirms the market is digesting the news. At this point, the key question for investors is not what just happened, but what comes next. Long-term investing is not about reacting to one quarter, but understanding the full business trajectory. Netflix still remains a fundamentally strong business with global scale and pricing power, but strength alone does not guarantee strong stock returns at any price. This map shows Netflix's global market slowdown. A strong company, but its high valuation demands discipline. Valuation always determines how much upside or downside is already priced in. This map shows the global Netflix market slowdown, illustrating varying regional pressures, and this probability chart shows how valuation impacts upside and downside risk. In Netflix's case, expectations were simply too elevated heading into earnings. The market anticipated aggressive growth, but reality fell far short. This imbalance caused the stock to drop sharply after the report. And when expectations are high, even good results can feel disappointing to the market. Take Netflix. They reported strong earnings, but the stock dropped sharply. This highlights the market's psychological nature. This disconnect between fundamentals and sentiment is what creates short-term volatility. Over time, however, the market tends to align back with earnings and cash flow reality. This long-term correction brings prices back to their true fundamentals. So the real takeaway is simple: understand expectations, not just earnings, because that is what truly drives stock market reactions. If you found this video informative and valuable, make sure to like, share, and subscribe to the channel for more in-depth financial breakdowns. Thank you for watching, and I'll see you in the next video.